We have seen the biggest drop in futures since the COVID pandemic began. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a manic Monday for markets. The global sell-off is intensifying with the NASDAQ 100 set for its biggest opening drop in more than 4 years.
Overnight in Asia, Japanese stocks had their worst day since 1987, with both the Topix and the Nikkei entering bear markets while the yen surges on the unwinding of carry trades.
And as investors weigh an emergency Fed rate cut, Goldman economists raised their odds for a U.S. recession in the next year to 25% from 15%. Let's take a look at where markets are trading right now because it is dramatic on this screen behind me. You can see the S&P 500 currently down by about 4% pre-market, even more so if you take a look at the NASDAQ 100. Your big tech stocks really bearing the brunt of this potentially as people unwind some of their winning positions, and the Russell 2000 down about 5% as well. Let's take a look at the VIX though, because you can really see the volatility in action right now. The VIX on the left of that screen right there, maybe the right for you, currently trading at about 60 right now. For context, we got to 80 during the real throes of the COVID crash. So we'll keep an eye on this one, Matt. Obviously, some big moves underway.
Yeah, only the third time we've seen a level that high since the 90s. Take a look at the SOM rule. This isn't a recession indicator that has been on the money since at least the 60s. Every time the 3-month average of unemployment goes and adds 50 basis points, we have a recession. That's happened for the last 9 recessions. It's happened again with the jobs number on Friday. So if we're not in a recession, it's the first time that this has happened without being in a recession in about 70 years. Also, take a look at the gap between the 2-year rate and the Fed funds rate. It has dropped to almost 200 basis points. It's also been a really good recession indicator going back to the 60s, and it's the biggest drop that we've seen, or the biggest spread in this rate series since 2008, since the great financial crisis.
Bond market volatility, index level volatility, and certainly stock level volatility. Of course, we're keeping an eye on Apple this morning, down more than 9.8% pre-market. Remember, that also has Berkshire Hathaway cutting its stake in one of its largest holdings. Amazon.com also down 8.6% this morning. Tesla down 9.4%. Want to flip up the board here and take a look at some of the other big trades. Remember, this was a market levered long on the technology industry and the Magnificent Seven, but certainly also the darlings of the industry taking a massive beating this morning. Matt, you look at NVIDIA down more than 12%, Intel down more than 6%. A lot of pain when you look at the semis and chips.
Yeah, I have to say, I went to Spain on Wednesday, and I was already surprised that the market was up in that session because you had the killing of the Hamas leader in Tehran. I thought geopolitical tensions would spur their ugly heads. Plus, you had the yen starting to climb, but it wasn't really until the non-farm payrolls number and this triggering of the SOM rule that markets really started to sell off in earnest.
Yeah, big time. It feels like things definitely took a different complexion this sell-off once you had that NFP report that was not great. It obviously missed expectations on the downside, but things really took on a different complexion than over the weekend with the unwind of that carry trade. Maybe as Asian investors had a chance to react to what we learned on Friday morning in the U.S.
And it's interesting. You now have many economists and traders seeking that inter-meeting rate cut, yet does the economic data really say so when so much of these market moves that you're seeing, guys, is based on that positioning that you had in markets, the unwinding of that carry trade as you're talking about, and systematic funds selling off. And by the way, when you put margin calls on top of that, you have to wonder how much pain there is to go.
All right, let's talk about this with Stuart Kaiser. He's head of U.S. equity trading strategy at Citi. And Stuart, it really, I think, looks like the recession fears, the growth fears spurred by the payrolls report is what kicked off this sell-off in stocks. Would you agree?
Yeah, I mean, I think that was a starting point. If you look at, how the market traded last week, you were up on FOMC day. The following day, you got that claims number was a little bit high. You got some internals to the ISM weren't great as well. And then you followed that up with A weak but not horrible jobs report. And, I think collectively what that did is it said, if you added up 3 or 4 data points, you'd throw ADP in there, you'd throw the employment cost index in there as well. You sort of had this massive data that suggested a relatively rapid loosening in the labor market. And our view has been you run long U.S. equity risk until that U.S. labor market comes under pressure. So that was the pressure point of the market in our view, and it has triggered a broader base selling. Whether it's all all recession fear is hard to tell, but that's been a key component of it.
And you listen to financial media this morning, you read through sell-side notes, you go on Twitter if you're that kind of person, and so many people are talking about the unwind of this yen carry trade. I'm hoping you can walk us through the steps there, sort of the daisy chain from I'm unwinding my yen carry trade right now to NVIDIA is down 12% pre-market.
Yeah, well, I think there's 2 aspects of the sell-off you could identify. One is if you're trading recession fears, that is broadly equity negative, and it's going to have much more pressure on domestically facing cyclicals. You put kind of IWM or small cap in that category. The yen carry trade would be more a positioning argument, right? So if you believe that the yen carry trade was happening, the question is where were those funds going? If those funds were coming into the U.S. and sitting in large cap U.S. tech growth stocks, then the unwinding of that just becomes a positioning pressure on the market, and that should be more acutely felt by effectively Qs and those large cap tech growth stocks. So I think if you're looking at the market today, you want to look at those 2 things. Does it look like the market's trading a recession and putting cyclicals under pressure, or does it look like the market is rotating, in which case you should have Qs underperforming IWM. In the recessionary, you'd have Qs outperforming IWM.
I think what's discomforting here is not knowing where the bottom is right now. If you believe that the carry trade is part of this, then how far does that deleveraging go, especially knowing that deleveraging is now becoming a broader problem. If you were levered long, you are feeling this today, and you are probably unwinding a bit more.
Yeah, I think, Sean, to your point, you don't unwind a trade you built in 2 years in a week, right? So if this is a true unwinding and you get that cascading effect, yeah, you still have room to go without a doubt, whether it's the yen carry trade or Qs. I mean, folks that are overweight NVIDIA didn't build that position in a week. They built that position over a couple of years. So you're not going to get out of it that quick. This will be a real test of retail. How devoted are they to the AI trade? And then secondly, to that institutional sponsorship of that AI trade. At what level do they say, I buy NVIDIA here because I need to own this for the next 3 to 5 years? And, we'll see. NVIDIA's held in relatively well the last couple of days, I think, given how high its beta is. But that'll be the test on the institutional side is what's your buy point and where is your kind of must-own level on some of these stocks?
I mean, the interesting thing is that some of these currents have been running for weeks, right? I mean, the yen has been strengthening since the beginning of July. So it's not like something that just happened last week. Also, Warren Buffett has been selling off huge stakes since, I guess, that time as well, right? He was selling Bank America, which he said is a stock that he could hold forever. He's been selling Apple like crazy. And if you're a retail investor looking at the Oracle of Omaha, this is like the guy behind the curtain, right? He's selling? This is the top. He's saying this is the top?
Yeah, but what I would say is during that period through July, you had kind of 3 distinct stages of this, right? You got the CPI print that was really light, and that triggered a soft landing trade. The soft landing trade, as I mentioned, is a rotation trade. You printed an all-time high on the S&P after that inflation print. So that was equities higher, rotating into cyclicals. You got the Google print. That created risk around what do I think the outlook for tech cap spending was. That was equities down. That wasn't equities up rotating. That was equities down. And now the third stage is you get this weaker sort of employment data, and now the market's trading a recessionary risk, right? And the question is, do you trade that as a pure recessionary trade, or is there an element of sort of position destruction that needs to happen alongside that? I actually think the equity markets have gotten it right in terms of how they've traded each stage of that. It does feel a little bit overdone, the degree to which the market is sort of chasing this recession.
But Stuart, do you not worry that Warren Buffett, that Berkshire Hathaway is saying this is a great time to sell high and start to build up cash for when prices are much lower?
The top?
Look, he could be calling the top. Look, for me, no. Like, I'm not looking at Warren Buffett selling Apple and saying that that's necessarily the top of the market. If you look at how retail behavior has evolved over the years, retail behavior used to be more of a buy and hold. I'm gonna, my grandkids are gonna inherit this stock. Now you have retail trading 0-date options, right? So the way retail trades has shifted, and it probably makes that kind of, Warren Buffett sell signal a little less acutely painful than it would have been in the past.
We got to get to zero DTE, but we have to talk about the VIX first because it has just been dramatic watching it all morning. A little bit below 60 right now. It had spiked above 60. We're at levels that we haven't seen all that often in the past 3 decades. You think about some of the volatility tracking funds out there. You think about some of the inverse VIX ETFs that exist right now. They're smaller and theoretically safer than they were during Volmageddon in 2018, but does that give you any pause?
I mean, it gives me pause to see how much the VIX has moved. I wouldn't have expected to be on a 60 handle this morning. All of those they're all vol-related stories. I think they all kind of fall in different categories. You might argue that this happening on a Monday is a positive in the sense that people didn't carry a lot of short vol over the weekend after what happened Friday. Zero-day trades, by their definition, are over at the end of the day. So if you're short a Monday zero-date option, you made that decision this morning. So you're kind of not underwater in that trade. I would say though, to your point on the ETFs, there's a lot more structural selling of volatility going on over the last couple of years, whether that's through, you have one-day override ETFs, you have the buffer funds, you have a lot of QIS and structured products coming out. So yeah, it is a risk. I wouldn't put it in the Volmageddon category. I would put it honestly in a similar category they put the large cap tech, because these are accumulated positions over a period of time that kind of need to rebalance themselves.
Real quickly here, is this a drop in the bucket of VIX flirting with 60, or is this a signal to stop selling vol?
Well, look, it's going to be a signal to stop selling vol for a period of time, because you're going to get a VAR shock that goes through, PM's risk management systems. And that's how you get this cascading effect, right? So you get the initial move, and then risk managers tell you kind of need to, pull risk in a little bit. So yeah, I think you'll get a little bit of a pause. But the bottom line is when people who are not getting burnt by the trade see a VIX at 60 and say, I want to be short that because that level is unsustainable. Vol is kind of a mean reverting asset.
No, absolutely. All right, Stuart, you're going to stick with us. We have more to talk about. Let's take a look at where futures are trading right now. Just about 20 minutes until the opening bell. You have S&P futures down 3.6%. NASDAQ futures off almost 5% right now. Same is true with the small caps.
All right, you take a look at some of the individual stocks moving underneath the market right now, and it's all the big ones. You have currently Tesla, Nvidia, and Apple seeing big declines there. You can see Tesla off by 9% pre-market. Nvidia actually leading losses right now, down 12%. We're talking about some of the biggest companies in the index, and of course, that's what's adding to that math there. Apple, this is one of the few stocks with a fundamental reason here. Of course, as Matt has been mentioning, Warren Buffett cutting that Apple stake by nearly half, just really adding to that sort of depressed sentiment. I think I'll call it that. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. The race to be on the ticket with Vice President Kamala Harris is nearing the finish. The presumptive Democratic nominee met with a short list of 3 potential candidates yesterday: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Harris also spoke with some other contenders on the phone, and she's expected to announce her decision tomorrow. The Prime Minister of Bangladesh, Sheikh Hasina, resigned after weeks of deadly protests saw about 200 people killed in July. The nation's army chief announced he would help form an interim government and had invited political leaders to meet today. Hasina had fled the country, or has fled the country. He's expected to be traveling now to London. And President Biden declared an emergency in Florida after Hurricane Debbie slammed into the area just southeast, I should say, of Tallahassee. The storm is the second Atlantic cyclone to hit the U.S. in 2024 after Beryl struck Texas last month and caused a massive power outage. More than 200,000 homes and businesses were without power this morning in Florida. Sonali?
And Matt, July's rise in unemployment triggering the SOM rule recession indicator. And the rule has a perfect track record, near perfect track record over the past half century.
Perfect.
The woman behind the rule, Claudia Saum, joined Bloomberg this morning.
Calm is important in a moment like this, regardless of what indicator or data point you're looking at. The fear does no good. And this was trying to give a simple summary of one piece of the U.S. economy. The labor market is very important. There's a lot of complications right now. And yet it's this balance between be calm, but take it seriously. Right? Like there is slowing in the U.S. economy, and we have seen that. The point is to keep that slowing from really pulling us in reverse. We're not there yet.
For more on recession calls, we are joined now by Michael McKee, Bloomberg's chief international economics and policy correspondent. You looked at the triggering of the SOM rule. You also looked at the steepening of the yield curve and the mild disinversion we've seen, at least for a moment. Michael McKee, what do you think this all means at the end of the day about the chances of a recession when the data is relatively strong but weakening? Where do you put it all?
Well, that's the thing, Sonali. It's relatively strong. It is weakening. The Fed expected it to weaken. Now, in the last week, we've had some signs that are a bit worrying, as Claudia was talking about. We had a weak ISM manufacturing number. We had a weaker than expected jobs number, although it wasn't all that bad. Jobless claims rose. That scared some people. The yield curve, as you mentioned, disinverting, and then we had some bad tech company earnings. Now, does that mean that we're going into recession? Not necessarily, because there's a lot of right things. I mean, so far this year, we're seeing the markets up, S&P and NASDAQ, up 12% each during the year to date. GDP stronger in the second quarter than it was in the first quarter. The Atlanta Fed GDP now is talking about 2.5% for the third quarter. The bond rally is stimulative. Mortgage rates have fallen significantly down to 673. And gasoline prices are falling right now. So there are offsets to the bad news. And the question is, do we see a recession? Well, it's hard to see from the NBER criteria. They're the recession arbiters, because they're all still rising, some more slowly than others. But in general, it would take a lot of reversals, a lot of revisions to these numbers to suggest that we're going to see a recession.
Yeah, and of course, Goldman out over the weekend, raising their odds, but still only 25% of a chance of a U.S. recession in the next year. Bloomberg's Mike McKee, happy Monday. Thank you so much. Citi's Stuart Kaiser still with us right now. So, again, a lot of talk about September, but a lot of talk about an emergency Fed rate cut. Of course, Jeremy Siegel making waves this morning, calling for a 75 basis point emergency cut. Would that help anything?
I mean, you might get an initial bounce in equity markets, but it also sends, I think, a pretty negative sign to markets, because it suggests either A, the Fed is so worried about liquidity and functioning of the financial system that they need to cut aggressively, or they believe the economy is decelerating at such a rate that the Fed needs to cut that much. So I actually think the signaling, you might get a bounce in the markets, but I think the overall signaling that would send to risk assets would be a negative.
Dude, that would be like yelling fire in a crowded theater. If they come in with an emergency rate cut, it's already like insane before the next jobs number, wow. September 6th, and then 75 basis points? I mean, who are we saving here, right? That's not going to change the economy on a dime. It takes, what are the long and varied lags, right? It's not like 2 minutes, it's 6 to 18 months.
Also just scream moral hazard here. At the end of the day, if we're talking about a generational unwind of a carry trade, what does it mean for a Fed to step into that kind of market?
Yeah, well, and that's my point. I mean, if they really think the unwinding of that trade is going to massively tighten financial conditions, that just sends a really bad message to risk assets. And Matt, that's why I always sit on an aisle seat near the exit, just in case this kind of stuff comes up. But yeah, Sonali, I don't believe the economic data we've seen over the last 2 weeks would justify an emergency cut. So if they're doing that, they are telling you they are,
purely reactionary.
Yes,
it sounds like.
Yeah, and also, or some people in the market will read it into they are seeing something that we are not, either through the access they have to bank funding and liquidity, or something on the data side.
Is this a start of a new paradigm to markets? You had a market levered long, as we've been saying, to Mag 7 names, to the semis. Do these trades start to, I mean, for the lack of better words, rotate? The rotation has looked different in the last couple of weeks, but has the market psychology changed?
I think it has. I mean, the first 6 months of the year and probably the last 12 months were really a higher for longer trade that was going through the system. That is evolving. And you're either getting into kind of a pure soft landing trade, which is kind of what you saw on July 11th with the CPI print, or you're trading, no, we're going to blow right through soft landing and go to hard landing, right? So I think what's changed is you've sort of, and PMs are having to evolve their portfolio out of a pure higher for longer into a, we're slowing growth a bit. Do I think that soft lands and I get insurance cuts, in which case I want to be long U.S. cyclicals and lower quality stocks, or I'm actually worried about this recessionary trade, which is obviously just a risk off, which is what we've seen the last couple of days.
Right. Well, going back to the concept of an emergency rate cut, or if the Fed does a supersized cut in September, 50 basis points or something along those lines, beyond just sentiment screaming fire in that crowded theater, I mean, what would that mean for the carry trade that we're talking about? Wouldn't that just exacerbate things?
Well, I mean, look, if you lower U.S. rates, then you have less rate differential globally, and I guess that might help. That actually would, to your point, sort of force more people out of the carry trade to some degree. The question is, do you get enough support from risk sentiment and financial conditions to kind of balance that out? Look, if they cut 50 in September, which is what's priced, the reason for that is going to be dependent to what Matt said earlier on the data we see between now and then, right? If we get another friendly CPI print on the 14th, and then you get, let's say we print 150 to 200K jobs in early September, then a 50 basis point cut is read as insurance. And you're going to have equity markets respond very positively to that. If instead you print 0.2 on CPI, but you print sub 150 on that early September payrolls, that 50 basis points cut is going to be viewed as a necessary solution to an economy that's rapidly decelerating. Rate cuts in that case are not nearly enough to support equities, and equity markets will be lower in that scenario, I think.
All right, Stuart, thanks so much for joining us. Appreciate you coming in this morning. Stuart Kaiser there, head of U.S. equity trading strategy over at Citi. Let's check on futures again as we head into the market open. Just about 8 minutes until the bell rings. We see red arrows across the board, big, deep red arrows. In fact, this will be the worst open for the NASDAQ in 4 years. Since 2020, when we all went into lockdown, it's down 5%. The futures are down 5%. S&P futures are down almost as much, 3 2/3%. Take a look at what's going on with the 2-year. The massive move in the 2-year yield really was on Friday, right? Now we're at 372, and the spread between the 2-year and the Fed funds rate is the biggest it's been since 2008. Take a look at the CBOE VIX there, up at 55. It has been up at 65 earlier, and the Japanese yen continues to strengthen against the dollar, right now at 142, making that carry trade more and more painful. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, CrowdStrike says that Delta ignored an offer for assistance in the wake of last month's system outage that led to thousands of canceled flights. The carrier was the worst hit airline as it struggled to normalize flight operations several days after the outage. Delta considering legal action against CrowdStrike. Next up, the confectionery giant Mars said to be in advanced talks to buy Kellanova. It could be one of the biggest deals in the consumer space this year. Kellanova, remember, was spun off from Kellogg last year, and the acquisition may help Mars fight back against a weakening consumer. And finally, Tyson Foods feeling on top of the pecking order today after reporting earnings that topped estimates thanks to a rebound in its chicken business. Producers benefiting from lower corn and soybean prices, along with a resurgence in consumer demand for poultry. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now coming up, we have Crossmark's Victoria Fernandez saying to buckle in for a bumpy ride. She joins us for the market open next. This is Bloomberg.
Moments away from the start of trading on what is going to be a very dark Monday open. This is Bloomberg Open Interest. I'm Matt Miller. A look at futures down. The biggest drop that we've seen for NASDAQ futures since 2020, since economies around the world went into an actual lockdown. That's the last time we saw the NASDAQ open this deep in the red. The S&P 500 futures are also taking a big hit this morning, down almost 4%. Here at the New York Stock Exchange, we have TXNM Energy ringing the bell on a day they probably won't forget. Over at the NASDAQ, you've got Hancock Whitney ringing the opening bell. We are seeing big drops in the cash trade. It looks like even worse than futures. Let's get over to Katie Greifeld right now to see where we're moving. Katie?
Yeah, I'm excited to tell you about it because there's a lot of action to walk through right now. The S&P 500 down more than 4% just in the first few seconds of the trade. Even worse, if you take a look at the NASDAQ 100, your big tech names really bearing the brunt of this selling right now. Of course, a sell-off that started in Asia with Japanese equities continuing right now at the U.S. Open, and the small caps, too, really taking a bath here. The Russell 2000 down by more than 4%, nearing 5%. But one stock to watch at the open is Tyson, one of the few stocks in the green right now. That's after it posted an earnings beat as a rebound in chicken profits helped to offset a downturn in its beef business. As you can see, shares currently up 2.4%, Sonali.
Speaking of chicken, there's some chicken going on in the crypto market here. You have Bitcoin dropping below $50,000, and so we're keeping an eye on those crypto-related stocks. Coinbase down 20% at the open. Marathon Digital also in conjunction around 20%, nearly more than 19%. Riot Platforms, a miner here, down more than 14%. Pretty remarkable. Now watching crypto, Bitcoin really at a third of its March high, a third of its value wiped out, Matt.
All right, let's take a look at the big behemoths here. In terms of Apple, you know, after the sell-off news over the weekend, Warren Buffett reducing his stake by tens of billions of dollars. Let's take a look at where it's trading right now, as well as NVIDIA. Let's go ahead and bring them up. Or maybe I will on my terminal first here. Apple right now trading down about 8%. 8% is the drop in Apple 202. NVIDIA also trading down big, wiping off probably $300 billion in market cap. NVIDIA down 14% right now. Let's take a closer look at the big drop in the biggest tech stocks with Abigail Doolittle. Abby?
Yeah, Matt. Well, this sell-off that we're seeing in stocks, it's not entirely surprising. We've been looking at charts all year of the stock indexes, Bitcoin, and individual stocks, pointing to the idea that there could be some sort of a real sell-off. Apple, no exception. Warren Buffett's Berkshire Hathaway started selling last December. That was a big reason why the stock was in a bear market up until April. It really should never have gone back above 200. It's there now, but well off the highs, the worst day since March of 2020. NVIDIA, also the worst day since March 2020. Too far, too fast. The AI craze ahead of the selling in NVIDIA, the bear market that it's in, it had been up more than 180% on the year. Amazon down 7%. Even stocks like Palantir reporting after the bell down 13%. With this, we're of course seeing the spike in the fear index, or more accurately, the uncertainty index. This is a 5-day chart, and I know that you were talking about this with Stuart Kaiser, but take a look at the VIX flatlining around a 15 handle, sort of a complacent level from a historic standpoint, all the way up to a 65 essentially, now coming off this, but nonetheless the highest level since March of 2020. And if we can connect this back to Apple, the Apple chart strongly suggests we have more selling ahead. This is a long-term range where Apple's basically going through, let's call it 170 up toward 200. Take a look at the drop right down into the range, the bottom of this range at 170, the RSI going down. It suggests Apple's going to sell off by another, let's call it 15% or so. As one of the biggest stocks, this could be brutal for stocks. The index is ahead.
Certainly off of peak panic for the morning, but a brutal morning nonetheless. Abigail Doolittle, we thank you for your analysis, and joining us now for more analysis, Victoria Fernandez, Chief Market Strategist at Crossmark. You look at this market, Victoria, there's very few places to hide. You really see the brunt of that bid in the bond market, but gold is down, Bitcoin is down, stocks across every major indexes are down for the most part. How do you position in this environment right now?
Well, what we're hoping is that a lot of people have done what we did with our clients over the past couple of months when we were seeing some of the warning signs that we thought we would see a larger pullback in this market, and start doing that rotation out of the momentum trade, start trimming some of those tech names that you had such high positions in, getting some cash on the sidelines and finding those areas in the market that we thought would do better in a downturn. So we were looking at some of the staples names, some of the healthcare names, utility names. You know, we liked financials, but we said wait for a pullback because financials had such a strong run. And we're starting to see those trades now start to do better on a relative basis. So do you go in today? I'm not sure. I think you take a little bit of a break today with what we're seeing in the market. Let things settle out a little bit, and then start looking at some of those names that we mentioned, some of those more defensive, more staple plays in your portfolio, and building those up while trimming some of your other ones.
And Victoria, I do want to talk about what's going on right now, what's going on today, because it feels like we're still in diagnostics mode as to what is actually causing this massive sell-off that we're seeing right now. Of course, there's been a lot of talk about the carry trade unwinding, particularly those yen-funded carry trades. Just walk us through sort of, again, the chain of events there. What is actually fueling this sell-off, and where did it start?
There's definitely, I think, a culmination of events that came together at the end of last week. The market is not reacting this way because the non-farm payrolls came in 60,000 less than expected, right? But I think that was kind of the straw that broke the camel's back in the sense that we look at earnings. I know earnings are up 11% year over year, but if you look across the board, you're not getting as strong of a guidance as people were hoping to see. So guidance is concerning regarding consumers. You were seeing yields already start to come down, not because inflation expectations were coming down, but because there were growth concerns coming down. You saw a lot of weakness in manufacturing and a lot of weakness in the labor market besides the payrolls number. You look at job openings, those were stagnating. You looked at quits, those were falling down. One of the most important recession indicators is really looking at the job differentials, job plentiful minus jobs hard to get. It hit a cycle low. So there were a lot of elements churning under the surface that were telling us growth is going to be coming back. Jobs are not there, wages are not there, and that means trouble for the consumer. I think Friday, again, was a culmination of all of that. Add in the unwind of the carry trade that you were seeing as the Bank of Japan raised rates and the expectation that we would be lowering rates in September after the Fed meeting. All of that coming together, I think the market came to realize, wait a minute, things maybe aren't as good as we thought. Maybe that soft landing is not a given. And that's why we're seeing the reactions we are. We also have geopolitical events going on that adds to the uncertainty.
Yeah, I was surprised, actually, that the market closed up on Wednesday after the assassination of a Hamas leader in Tehran by Israel. Nonetheless, it looks like the market has discounted that, Victoria, and is more worried about really the jobs picture, right? But is that recession indicator going to be on, as GDP was 2.8% in Q2? Atlanta Fed Mike McKee was just telling us is forecasting 2.5% GDP in Q3. That doesn't really feel recessionary at all. Why would the Fed come in with an emergency cut?
I'm not sure they will come in with an emergency cut. I know the market is talking about that. Are the expectations of a 50 basis point cut in September moving much higher? Yes, and that's probably more of a possibility than a cut before that meeting. Jackson Hole will obviously be an opportunity for the Fed to lay out its plans and give us a better clue as to what's going on. But I do think you're looking at, look at 2-year yields to Fed funds. It's minus 164, 165 basis points. Again, we only see those levels prior to recessionary periods, 2000, 2008, before the bank crisis in 23 and 98. We're seeing all that. And the labor market is telling you in a lot of different ways, like we were just talking about, with wages coming down, that the consumer is going to be at stake. We're hearing it on the earnings calls as well. Credit card delinquencies going up, auto delinquencies going up, travel coming down, restaurant spending coming down, big ticket items and luxury items spend coming down. So I think the market is starting to get a feel that, okay, we are slowing. The Fed did not, loosen those restrictions at all. So we have a little bit more time where there's still a little bit of squeeze on the consumer. All of that is concerning the market right now. I think we'll see the Atlanta GDP number come down over the next couple of weeks.
And even at the top of this hour, we have, of course, that ISM services data coming out, and you have a market that is kind of on tender hooks here, isn't it, Victoria? If you think about kind of the forward catalysts, how long do you sit out this market for? You had mentioned a little earlier that this wouldn't necessarily be your time to dive right in. What would be that time?
Yeah, I was actually listening to some technical analysts this morning, and they're saying in the short term, right, in the next couple of weeks, you could get a bounce from an oversold position. I mean, look at the levels that we're trading at right now. These are huge drops over the last 2 trading days. So you could get a short-term bounce. Maybe that's an opportunity to trim some names and get some cash available. But in the intermediate term, over the 3-month time cycle, it's showing that we will probably move down even further, which puts us kind of towards the end of October. We know September historically is a very tough month for the equity markets. So I think I would wait a little bit longer. You're not going all in a position at one time. You can dollar average a little bit on these days where there's pullbacks. I would just be cautious and kind of take your time over the next couple of months, because I don't think today is going to be our final down day.
All right, Victoria, great intel there. Thanks so much for joining us, Victoria Fernandez of Crossmark. This is Bloomberg.
All right, it's time now for Top Call. Some of the analyst action in focus this morning. And first up, Citi raising Robinhood to a neutral rating. The analyst says that the company's fundamental story has been improving. Next up, we have RBC Capital Markets cutting Moderna to a sector perform. The analyst notes that the pharma giant's increasingly uncertain outlook as it faces headwinds for both RSV and COVID. And finally, we have Daoud Securities downgrading Mobileye to neutral. The analysts over there citing the company's materially lower forecast for the second half of the year because of weakness in China, Matt.
All right, one stock, other than Robinhood to watch. Robinhood is down 18% after Citi raises it to a neutral. I guess raising it to a neutral doesn't help very much. Apple though. Berkshire Hathaway slicing its stake in the tech giant by almost 50%. The sale is part of a selling spree that has boosted Warren Buffett's cash pile to a record $277 billion. Here with more is Matthew Palazola. He's our Bloomberg intelligence analyst for Berkshire. Amazing, first of all, the sales, right? Because it started with Bank America, which is a stock that Buffett said he could keep forever. Apparently not. He started selling that, and now we find out that he was selling tens of billions of dollars of Apple to a retail investor, and maybe to some institutional investors. This looks like the guy behind the curtain is saying, I'm out at the top.
He's still in, though, to be clear.
So he's still in. I would say this, Matt. In fairness, I think he telegraphed this a little bit in May at the annual meeting. They sold, I think it was maybe like 10% of their position at that time. And Tim Cook was there in the audience, and people were asking him about it. And he had said, I expect this to be a stock that we're going to hold. I expect it to be one of our biggest holdings. But he was just, it seemed like he was letting on like, we're not done with this. He had talked about capital gains taxes maybe going up, and that might be a reason to harvest a little bit. He had also talked about being worried about businesses with some reliance on China.
Is this him telling you that he's calling the top in a lot of ways, or is this a matter of him saying it's better to hold cash now? Let's keep our powder dry. There will be large whale opportunities moving forward. We haven't seen Berkshire make a significant acquisition in a while.
So I would say it took the interest rates going up, took a lot of the pressure off them holding cash. So I think they're a little more comfortable doing that than they've been in the past. Buffett's not really known to be trying to play the market to try to sell at the top of the bottom. He talks about buying these stocks as buying businesses. I do think it probably shows a little bit of less confidence in his idea of the long-term prospects of Apple, though.
I did want to ask, what's he going to use this on? He's collecting, of course, the proceeds here. He's still in Apple, but he's cut his stake by nearly half. What's he going to do with all the money?
It's really tough to say, right?
Yeah.
If I knew that, I wouldn't be taking the Metro North to work, right?
At least you're not on a New Jersey Transit.
Exactly.
It could be worse.
Could be worse. So he bought some Chubb stock in I believe it was in the second quarter, and that's one of their bigger positions now. That's an interesting story. Two insurance giants perhaps getting together. There's no real evidence of them buying more of it, but I think it might be in something that we just don't know. And he's talked a lot about there's just nothing out there big enough for them to move the needle.
But Matt, don't you think? The fact that the Oracle of Omaha, this is the guy who knows, right? He's selling stocks now and building up a war chest of $280 billion in cash. Doesn't that seem exciting at a time when the market turns over?
It seems exciting. I wouldn't put it, though, as if he's selling everything, right? If you look into the numbers in the 10Q, really the only big sale in the second quarter was Apple. So he didn't sell most of his other stocks. He's been selling the Bank of America stock in the third quarter. And those two holdings together were half of their portfolio. Even right now, Apple still represents about 15% of their cash and investments.
Matthew Palazola of Bloomberg Intelligence, we thank you so much for keeping your eye on that massive cash hoard. Many other people wish they were holding cash right now as well. Want to take a look at this market right now, though, because you're looking at an S&P 500 and a NASDAQ 100 off of session lows. I also want to take a look here at sectors because it is pretty ugly out there almost across the board here, because you have information technology down more than 4.5% really still on the day. Financials taking a beating, down more than 3%. Real estate, energy, all down on the day. I want to take a look here also. Now the NASDAQ 100 looking at a downturn of about 3.5% on the day. Again, off session lows. A fun fact, there are some stocks in the green to be had here.
Yes.
Earlier today, you had CBOE, which is behind that VIX index, also launching a new VIX product later this year, actually hitting a record earlier today. So not everybody loses
Well, and
from volatility.
Kellanova, right, the maker of Pop-Tarts, rising.
Tyson's as well.
There you go. There's a few stocks that are gaining in this market. Here are the indexes. None of those are gaining right now. But they're off their session lows. The Russell 2000 down almost 5%. This is Bloomberg.
It's time now for the Wall Street beat. Global funds have been levered to a carry trade that has been unwinding, certainly since the Bank of Japan raised rates and the Fed kept still. And now the divergence between the rates are widening, and it's unclear how much more pain there is to come. And joining us now is Liz McCormick, Bloomberg's chief correspondent for global macro markets, and explain what is happening here with this carry trade that has existed, because you can say that this is really somewhat of a generational shift as we watch this divergence, but unclear how much it has meant for this trade to unwind. Explain the trade.
Yeah, well, let's remember the trade is forever. Rates were so low in Japan, for example, and it made sense to borrow in that currency, so in a sense short the yen, and invest where rates are higher, the U.S., Mexico, etc. Now, the key to the carry trade, a carry is like you sit there and make carry, interest rate differentials, but the key that it really works to is that volatility is low, because if the currencies move against you, you could lose a lot on the currencies, and that's not only, like you explained, the yields have started to kind of go the other way. Bank of Japan raised rates just a little, but they started. And like we can see, and you've been talking about how much people are pricing in, the Fed's behind the curve. We're going to have these massive over 5 cuts this year. So that rate differential got turned on its head somewhat. And volatility. People are like heading to the hills. Like you're talking in all these asset classes. When you see this rout begin, it just escalates other things. So people are like, this carry trade, which seemed like the easy trade, is no longer. So you start exiting fast, and it starts to be self-fulfilling, unwinds and unwinds and unwinds.
And I guess that's what we've been trying to get at all morning, is kind of understanding the chain of events here. So if I am managing a big multi-asset portfolio and, oh my goodness, I have to unwind my carry trade right now, how does that exactly affect other parts of the portfolio? How does that translate into NVIDIA being down double digits?
Well, remember, and I think it was the BIS, don't hold me to it, but they did say the carry trade was like expanding to broader things. And Matt, you were joking about NVIDIA, that, you know, you can invest where yields are higher in, say, the U.S., and you could buy stocks. You don't have to be in fixed income. So it seems like it's all building. Now, we don't know all the data where these people are, but say they're unwinding this carry trade, and some of that money was going into stocks. So that's adding to it. And I think what happens, too, is it's like a self-fulfilling, right? People say, oh, it's not going to go that far, but maybe I better get out, you know, like you just, and it starts to feed that fear, you know, that fear concept. So I think it's all kind of breeding on it itself.
If you take a look at, you know, just a simple yen chart, you can understand why the trade is so attractive, right? It's been weakening for so long that it made sense. You can just short the yen and use the proceeds from that short to buy NVIDIA, because NVIDIA has been climbing and climbing and climbing and climbing. Now, I mean, we saw a dip. You can see this is a 5-year chart here. We saw a dip in the yen at the end of 2022. That probably put a damper on carry trades for a while, but surely they came roaring back to life. This isn't the end of it, is it?
No, and I don't want to date myself, but I've been through a few of these cycles where, you know, the trade works until it doesn't, and then everybody's out and they call the death of it, and they come back, because that's just human nature, and it is a good strategy, of course, when it works. So it just, I've just seen it so many times, you know, it's
a circle of life.
It's a circle of life.
I think what people have to understand, this is a form of embedded leverage in the market, and no one knows how far that leverage goes.
Yes, it's embedded leverage.
Embedded.
What does that
in
mean?
There.
Okay, I get it.
It's under the surface.
Got it. All right. Liz, thanks very much. Liz McCormick, they're talking to us about the unwinding of the carry trade. Let's get to your trading diary right now. What you need to be watching this week. Tomorrow, we get earnings from Caterpillar, Uber, and Airbnb. More earnings from Disney, Novo Nordisk, and SoftBank on Wednesday. On Thursday, we get earnings from pharma giant Eli Lilly, which is going to be fun because we'll get to talk about, what do you call those things again?
GLP-1s.
GLP-1s, which I still need to get hold. I ate so many chocolate-filled
so many vegetables
croissants when I was in Spain. All right, Alibaba rounds out next week. If you're watching Chinese companies with their earnings on Friday, and maybe that'll tell us something about the consumer, more like in China than here. Take a look at stocks right now. We have not the session lows, but still big drops, right? The S&P 500 off 3.25%. The NASDAQ off 3.5%. Small caps down almost 5%. The rout rumbles on, but it's not as bad as Japan overnight. They had a 12% drop on the Nikkei, the biggest in a decade. When we come back, we're going to talk to the CEO of Vanguard. This is Bloomberg.
Send an email.
We are 30 minutes into a 4% sell-off. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, a manic Monday for markets. The global sell-off intensifies with losses cascading across tech, and Wall Street's fear gauge soaring to the highest since 2020 before moderating.
As investors weigh an emergency Fed rate cut, Goldman economists raise their odds for a U.S. recession to a whopping 25% next year. Maybe underplaying the possibilities.
We'll have to keep an eye on that one. But also, just about a month into the job, we'll talk to the new Vanguard CEO, Salim Ramji, about what's topping his to-do list amid the market mayhem, or longer term. But let's get a check on these markets right now, because it's not pretty out there, but it's not as bad as it was. You have the S&P 500 down about 2.5% right now. When markets opened just about 30 minutes ago, that was a 4.3% decline. So giving back some of those losses. Same thing, too, if you take a look at the NASDAQ 100, though, of course, that is down more as big tech really bears the brunt of this selling. The NASDAQ 100 off by about 3%. That bond market rally, it's continuing. The 10-year yield down about 3 basis points right now. Remember last week we were above 4%. Now we are well below that band.
All right, we're getting better economic news today than we did on Friday. ISM services data crossing the terminal right now. I was braced for a disappointment, right? But it's actually better than anticipated. The ISM services index, 51.4. We were looking for 51 even. If you look at new orders, for example, 52.4, and we were looking for a contraction at 49.8. Joining us to talk about it is Michael McKee, Bloomberg's chief international economics and policy correspondent. And Mike, remind me why it would have been bad to see a disappointment, a contraction here. Would it have been a very bad signal for the economy?
It would have been a bad signal for the economy if we continued to see contraction, because the services component of GDP is the largest, 2/3 of it. So the fact that we are seeing expansion again after 1 month's dip below is relatively good news, and I can tell everybody out there, take a breath. You know, slow down, take a breath.
You're actually seeing yields, the 2-year now flat on the day. So you have the market certainly taking a breath here on the heels.
Right. Just about every category improved. The business activity production number went up to 54.5 from 49.6. New orders 52.4 from 47.3. Employment 51.1 from 46.1. This is sort of the mirror image of the manufacturing ISM that we got last week, in which everything was pretty bad. The prices paid number goes up to 57 from 56.3. A couple of months ago, that would have been some worrisome news, but right now it gets lost in all the news about growth, and at this point, the ISM numbers are telling us that growth is
And you can see that bond market taking a breath right now. You take a look at yields. We're actually back to flat when it comes to the 2-year yield, when it comes to the 10-year yield. So someone's listening to you, Mike McKee, out there in the
Listen
audience.
to me.
And the stock market as well, right? I mean, now we're only down 2.5%.
Just a 2.5%
on the S&P 500. Well, we were down 4%. So
I agree.
Yeah.
All right, Bloomberg's Mike McKee, thank you so much. Let's get right to Mandy Zhu right now. She is CBOE, Head of Derivatives Market Intelligence. And Mandy, curious to hear your reaction right now. Of course, you wake up this morning, you see that everything is selling off. Now it seems like we're taking a little bit of a breath. What's going on?
Sure. I mean, I would separate the price action we saw last Friday, which I would characterize as very much fundamentally driven, versus the price action we saw over the weekend and into the open today, right? So if you look at like last Friday, what we saw was a broad-based increase in equity volatility across indices, across markets, U.S., Europe, Asia, on the back of, worse than expected U.S. data and growing fears of recession. Like that's, very well understood and well deserved. And then you look at what happened pre-market today with the VIX, exceeding highs that we haven't seen since March of 2020, with no change in really any macro fundamental news. Sure, we got, the big sell-off in Japan, but in terms of what has changed for U.S. equity markets over the weekend, nothing. So to me, the price action this morning and today is very much positioning driven. It's very much liquidity driven, whereas the price action we saw on Friday was much more fundamentally justified.
Let's talk about the VIX for a second, Mandy. Sonali pointed out earlier that we've only seen it peak above 60 3 times since the 90s. Here's a one-day chart, and you can see, the moves have been massive. At one point, we were over 65, and now we're under 40. It's still elevated. What is the activity in the VIX telling you?
So last Friday, of course, we're just getting started on the trading day today, so we'll see what the numbers end up being. But last Friday was one of the highest volume days we saw in terms of VIX options, over, I think, 3.5 million contracts traded that day, the highest since Feb 18, which was obviously the big, Volmageddon episode, and higher than any point that we saw during COVID, which I thought was very impressive. But in terms of actual flows, I would say it wasn't all panic buying of hedges. We saw plenty of monetization of existing hedges. This is a theme that we've been highlighting for a while now. For all throughout this year, even as VIX was kind of hitting really low numbers, we saw record activity in VIX options as investors were kind of playing for that unknown, exactly what we saw over the weekend, right? A liquidity-driven or a geopolitical-driven event that really spiked volatility. They don't know when it was going to hit, but we definitely saw the buildup in terms of VIX option buying and option activity in the lead up to this event. And on Friday, we saw plenty of monetization of hedges, as well as people playing for a normalization and volatility. What I thought was interesting was actually we saw a bigger increase in volume in VIX puts than we did in VIX calls, which kind of tells you that people are potentially playing for that retracement or normalization and volatility going forward.
Mandy, a little more on this here. If you think about the positioning driving a lot of the sell-off that you have been seeing into today, of course, moderating now, thank goodness for the traders that are feeling those losses. When you think about the positioning moving forward, how much of the deleveraging has already happened? Is it now more of the unwinding of the carry trade, or is it really the positioning you're seeing in volatility being squeezed out that's creating more of the issue?
So I would say it really started out in Japan. I don't think this was something that started, again, in the U.S. markets, because, we saw in terms of price action on Friday, that was a U.S.-led market sell-off in terms of weak U.S. data. And yes, the VIX did spike, but, ended the day, in terms of 23, in terms of levels, still relatively muted. So I don't think I don't think the current kind of panic that we're seeing is really driven by fears of U.S. recession or any kind of macro fundamental catalyst. It's really positioning, and you think about kind of what are some of the hedge fund darlings year to date, right? It's Japanese stocks, it's a lot of the positions where you talked about in the FX market, and of course in the U.S. it's large cap tech, right? And that's exactly what is selling off the hardest. To me, that's a telltale sign that this is a positioning driven sell-off. Because if you look at the spike in volatility today, what's really notable to me is a huge divergence depending on what index or what region you're looking at, right? So obviously Japan and U.S. equity vols have exploded the most. But if you look at Europe, look at these stocks, right? European equity vol up, much more modest, 10, 15 points compared to the 30, 40 points that we're seeing in the U.S. and Japan, because again, that has not been a crowded trade, but that's not where we're seeing the deleveraging happen.
Right. And Mandy, I'm really interested about the ripple effects at a fund level, especially when you take a look at the ETF space, for example. There's just been this explosion of assets in these vol-selling funds, for example. And I'm wondering, I mean, you think about how long they've been in existence and how much they've grown over the past 4 years. This feels like one of the first big tests of those strategies. How are you expecting they'll fare?
So I would say the term vol selling as applied to the growth that we've seen in option income funds is really a misnomer, right? So those funds, I think what you alluded to is, it's the growth in terms of ETF assets and mutual fund assets in, generally like call overwriting or other very vanilla strategies where there are no embedded leverage. I think, you guys talked about earlier, it's all about embedded leverage. Where are we seeing hidden leverage, embedded leverage, and where is that getting unwound? It's not in these funds. They are covered call writing strategies. And for a lot of these portfolios, there's going to be no forced unwinds today. Nothing changes really fundamentally. And actually, from a performance perspective, they outperform in a day like this where markets down a lot because of the option premiums that they have collected. So from my perspective, they're not a driver, nor will they be a casualty of this volatility spike.
Mandy, we thank you so very much for your time, of course, on a very complicated day of trades. That is Mandy Zhu, the CBOE head of Derivatives Market Intelligence. Let's now get a look at the stocks moving at this hour. There are many. Here's Abigail Doolittle.
There certainly are, Sonali, and it is a complicated day in some ways. Everybody's searching for a reason, but you could also just say that there's more sellers than buyers. We certainly have this as the case in the chip sector, the AI craze letting up. So you have the likes of Intel, NVIDIA, ARM, Supermicrocomputer all down sharply. Many of these stocks up triple digits at some point this year. NVIDIA may actually still be. That's the degree of too far, too fast, even though the numbers are really pretty solid. Investors now rethinking that animal spirits, the froth, the yen carry trade unwinding. That's also bleeding into the crypto space. Bitcoin, of course, over the last several days, down 30% from the recent peak. We've been showing charts suggesting it could go to 40K. That's taking down many of these crypto-related names. Although that said, these stocks well off the lows. Coinbase at the lows down 21%. So investors, there's some buying the dip here, at least in the crypto space. It's not just tech and crypto, though. If we widen it out and we take a look at some of the other stocks, Matt, take a look at Citigroup down 6%. So the bank's under pressure. Tapestry, the retail sector down almost 7%. Freeport-McMoRan sliding with gold and copper, commodities under pressure. And then Berkshire Hathaway, which reported, of course, over the weekend, down 3.5%, a cash stake. But this is really basically a proxy for the S&P 500. Not a lot of places to hide. The last time I looked, just 10 stocks up in the S&P 500. The rest down, and many of them down sharply.
Is Tapestry, can I buy things at Tapestry? Is it?
I think you can.
Do they have?
You can.
Yeah? Because it's the name of a Carole King album. I'm not sure if you know that.
No, that's
so it sounds like it's more of a women's fashion.
It is.
Oh, that's what
You do have 2 daughters.
Yeah, well, but they're not Carole King's age. Let's take a look at what's going on in terms of stocks right now. We have a bit of a bounce back, although still massive drops. The S&P 500 down more than 3%. It had been down 4.25% at its worst point. The NASDAQ had been down 5.5%. It's still down 3.5%. And you can see the Russell 2000, the small caps, down 4.4%. Now, in terms of a cross-asset check, the U.S. 2-year still down 381, but we were off 15 basis points, and now we're off 6. So a little bit of a lessening of the blow there. The VIX, you can see 42. We had been at 65, and the yen right now at 143. Just about a month ago, it was trading for more than 160 to the dollar. So that shows you the huge climb we've seen in the yen versus the greenback.
Yeah, certainly feels like a long time ago. Meanwhile, we do have some breaking news. This coming from Down Detector. Users reporting some issues with their trading platforms. Charles Schwab aware that some clients have difficulty logging in. They're commenting on the platform issue on social media site X. You also have Fidelity working urgently to resolve login issues. Of course, we're going to continue that to follow that story and what's going on in the market. It's going to keep the conversation going with Nancy Daoud. She is Ameriprise Financial Private Wealth Advisor, and she says it's a good opportunity to deploy new cash during these market dips. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Iran reiterated that it wants to avoid an all-out war with Israel, even as it threatened to retaliate for last week's assassination of a leading Hamas figure in Tehran. After vowing revenge, a spokesperson for the Iranian Foreign Ministry said it aimed to deter Israel from repeating similar moves in order to reinforce stability and security in the region. And the race to be on the ticket with Vice President Kamala Harris is nearing the finish. The presumptive Democratic nominee met with a short list of 3 potential candidates on Sunday: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Harris also spoke with some other contenders on the phone, and she is expected to announce her decision tomorrow. Independent presidential candidate Robert Kennedy Jr. reportedly confessed yesterday to leaving a dead bear cub in Manhattan's Central Park 10 years ago and staging the carcass to look as if a bicyclist had run over it. Mr. Kennedy posted a video detailing the bizarre story ahead of an article in The New Yorker that mentioned the incident. He said he thought it would be amusing, and oddly, I think he was right. Sonali?
You know, we're going to go back to the stock market here because it's interesting. That bump that you saw after that ISM data came out is waning a little bit, but you are not at session lows anymore today. You are still seeing the S&P 500 down nearly 3%, the NASDAQ 100 down more than 3%, those small caps, mid caps, the Russell 2000 still taking a real beating here, down more than 4.3%. To make sense of it all, we now are going to speak with Nancy Daoud, private wealth advisor at Ameriprise Financial, joining us on set now. And you see these dips. And the question is, do you wait for a larger shakeout before you step in at a greater rate, or do you start to pick at the heels of what's being sold off?
Well, I can't deny that it can be very unnerving having 3 days in a row with, major declines like this. But we tell our clients to just take a deep breath and remember that we're in this for the long term. And for the first part of the year, the lion's share of the first half of the year, it was crazy. I mean, it went up so much that there had to be some kind of a correction of some kind. And this is just an opportunity to deploy some cash that's sitting on the sidelines. Mm-hmm. So if you are already fully invested, stay the course and don't bail out, because then you guarantee your loss if you do that. And if you're not fully invested, this is an incredible opportunity to buy some bargain prices.
Not a loss, though, right? If you're fully invested, I mean, you're up still 9% year to date on the S&P.
Yeah, 20% over the past year, too. So there you go. But to your point that if you're not fully invested, now's a good time to go in. Is that a broad-based buy right now? Or are there certain areas that you would still maybe stay away from?
Well, clearly the tech sector is taking the biggest beating, but it's also the one that went up the most earlier in the year. So if you're not fully invested in tech stocks, that would be a great opportunity. But really, as you mentioned earlier, the entire broad market is taking the beating right now. It feels like once the sell-off begins, the entire market follows suit. But I say it's still very early in the day, and it's a long way to 4 o'clock, and we sometimes think of the stock market like an NBA game where the real excitement happens in the last 5 seconds.
By the way, I'm, I guess, conservative by nature in terms of investing. I lost a lot of money gambling at a state fair when I was a little kid.
Did you really?
So,
shocking.
You know, if I had my cash parked somewhere where it's earning 5.5%, 6%, and I see these yields tumbling to below 4, I'm going to think, I'm going to hold on to that, right? I don't necessarily want to deploy that cash when it's already earning so much. When is the next time I'm going to be able to get, a 5% coupon on a 10-year bond?
Well, that's actually very logical thinking. However, it really has to do with how long are you in it for. If you're in it for the longer term, 5, 10 years or longer, you're not going to get that 5% for that long, because interest rates, I mean, if you even look at CDs now, if you go out more than a 6-month term, the rates are actually lower than the 6-month and the 3-month terms. So already there's an anticipation of rate cuts coming up. So if you're in it for the shorter term, then your logic is perfect. Then stay the course with the 5%. However, if you're in it for the longer term, for retirement or college funding or something bigger, then you should definitely look into
Take
buying
on more
some
risk.
stocks.
We've been watching investors also redefine rotation, and it's really easy to talk about technology like it's the only part of this market right now. But you watch the other places that are selling off today. Let's take financials, let's take energy. How much of a rotation do you think should go into areas like that, given how badly they've been beaten lately?
So, there's so many factors involved here, in addition to it being a personal matter. It's not a one-size-fits-all situation. But when you're going in as an investor, the time frame, the risk tolerance, but we're also on the verge of a presidential election. And we've noticed that in the last several elections, maybe 44 years, 11 elections, value has outperformed growth immediately 6 months post-election. So that would be what I would be looking into at this point, and the prices are certainly attractive now.
All right, Nancy, great to speak with you. Get your perspective, of course, on a very turbulent day for markets, if we want to call it that. That, of course, is Nancy Daoud of Ameriprise Financial. Meanwhile, let's take a check on that market, of course. Just about, 50 minutes into the U.S. trading day. Things are still bad, I would say. The S&P 500 down about 3%. We're off the session lows, but of course, 3% drawdown right now on the day. The NASDAQ 100, big tech really bearing the brunt of that sell-off right now. You can see your big tech names currently down about 3% as well. Small caps, they are your biggest loser in this market, down about 4% on the Russell 2000 index. We're going to continue to follow that one. Now, coming up, we'll be speaking to the CEO of Vanguard, the world's second largest asset manager. That's coming up in about 9 minutes. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Oreo maker Mondelez says it expects the price of chocolate to fall. Remember, cocoa prices are headed for their second month of losses thanks to growing optimism on next season's output. And next up, Coca-Cola says it will pay $6 billion in back taxes and interest to the IRS following a federal court decision. The Cola King said it plans to appeal this ruling. Now, this dispute specifically covers the fiscal years 2007 through 2009. And finally, Warner Brothers Discovery says it signed up more streaming customers during the first 4 days of the Paris Olympics than it did during the entire Tokyo Games. The return of the Games to a historic European capital after a decade in Japan, China, South Korea, and Brazil has generated buzz with viewers, and the media giant says that the time zone helps boost subscriber numbers too. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right, let's take a look at what's going on with stocks right now. The averages aren't looking as bad as they were. However, as Katie said, it's still not great. You have the S&P 500 down more than 3%. The NASDAQ, oh, by the way, the S&P 500, that means, is up less than 9% year to date, right? A couple weeks ago, it was up 18% year to date. The NASDAQ is down 3.33%. This morning it was off 5.5%, so it looks a lot better, but still horrendous, obviously, if you bought yesterday, or Friday, I should say. The Russell 2000, that rotation that we had seen for a couple of weeks, looks like it's over now. The small caps, I should say, are down 4.33%. In terms of the U.S. 2-year, its yield is still down. The arrow there is green because the price obviously is up.
They're inverse.
385. That's true. I feel like when the yield is down and the arrow is pointing down, the color should be red.
But it's a rally, you know?
Well, then we should show the price. Anyway, the CBOE VIX index, you see how the arrow's pointing up, and it's green. That makes sense. Up 19 to 42. It had been 65, so not as high as it had been. And the yen at 143.
Also looking at some individual movers this morning. Tyson still in the green, posting an earnings beat as a rebound in chicken profits helped offset a downturn in the beef business. But also watching big tech here because Apple's still down more than 5.2%. Nvidia down almost 7%. It's really paring some of its losses here, but still an ugly tape, guys.
I'm really glad that Tyson is on the board there. It's a good reminder that we're still in earnings season and we have a lot of idiosyncratic moves as well. Tyson up about 2.6%. Now coming up, Salim Ramji is 4 weeks into the job as CEO of Vanguard. We'll discuss his plans for the company and more next. This is Bloomberg. This is Bloomberg Open Interest. Let's take a check on stocks right now, about an hour into the U.S. trading day, and what an ugly day it is. The S&P 500, it had been pairing gains, now they're, or losses rather, now losses re-accelerating. You see the S&P 500 down about 3.4%. Big tech down 3.7% on the NASDAQ 100, even though you have the likes of NVIDIA taking back some of those losses. Small caps, though, consistently the underperformer today. The Russell 2000 down about 4.6%. Then you take up a look at the cross asset board, for example, and you can see that this is really a broad-based move. Bonds have been acting as your haven of choice right now. The 2-year Treasury yield down about 4 basis points. The VIX really skyrocketing today, but off the absolute highs above 60. Currently trading with a 43 handle. And then the yen, of course, maybe ground zero for when you think about this sell-off that we're seeing across markets. Dollar yen currently trading about 2% lower. Let's zoom out, though, because we want to bring in the CEO of Vanguard, Salim Ramji. He took the helm just under 1 month ago, on July 8th, actually, launch day of this show. Salim, it's great to see you in person.
It's great to be here.
So I don't know if you know this, but there's a huge sell-off underway right now in markets.
I thought this was going to be a quiet day in August when I first agreed to do this.
You and me both.
Yeah.
Well, I want to get to your big picture view for Vanguard, but we have to start, of course, with the news of the day, and that's that Schwab, Fidelity, seems like the whole industry is dealing with outages right now on their trading platforms. Are you having any troubles over at Vanguard?
Yeah, as best we can tell, it's an industry-wide kind of slow set of issues. For us at Vanguard, we were impacted by some of the slowness that's happening all across the industry as a result of higher volumes all across the industry. Our kind of success rate for web logins and the like is kind of 98.9%. So it's fine. It's not as much as we want it in the normal course of the day. But at least as of 5 minutes ago, things were kind of getting back to normal, if you will. We benefit in some ways as Vanguard because we don't have a large active trader population by design.
Right.
We're about long-term investing and we're about staying in the market rather than timing the market. But at the same time, we're always looking at what the industry kind of issues are and how they impact our clients, and the team has been on it, particularly with the higher volumes that we expected.
I was going to say, you know it's a big day when your buy and hold Vanguard investors are trying to log in and see what their investments are doing, but we'll continue to look for updates on that situation. Yeah. But let's talk a little bit about you. Let's talk about Vanguard, because you made waves as the first outside CEO hire since Jack Bogle, of course, founded the company in the 1970s. What's on the top of your to-do list?
So there really are three things, Katie, and it's been great, to really get started, which I did just as the three of you got started on your new show back on July the 8th. And the first piece is really just listening and understanding what's foremost on the minds of our clients. And so I've been spending a lot of time, both here today, over the past few weeks, meeting with some of our large retirement services clients, our large wealth management clients, but also just listening in on the phones and listening in with our advisors as they're dealing with the kind of advice and all the day-to-day issues for individual investors as well. And so it's really just first and foremost making sure that we're taking care of and serving our clients well for today. And I think that the second piece is really about getting to know all the crew. I've been spending a lot of time at my new home in Malvern, but also in Charlotte and Scottsdale, in a couple of weeks in London, to really get to know our crew all over the world and really understand the culture from the inside. I've admired the culture from the outside and all of Bogle's writings and works, but really being able to see it and see how our crew members really believe in the mission and believe in the purpose and understand what's important to them is also kind of high on the list. And I would say the third thing is really with a view to the future.
Right.
What are the changing needs and expectations of our clients, whether it's around things like retirement income or people investing for the first time or getting access to a broader range of low-cost investments, even well beyond index. These are all things that I think our clients are asking for. I think that they're things that we can deliver.
I guess.
But it's about the future.
I guess the future is why they hired an outsider, right? Because they could have hired an insider to just keep the culture the way it is and not change anything. I interviewed your predecessor, Tim Buckley, in Frankfurt a few years ago when he was making a big push to grow the ETF business in Europe. Vanguard could really grow more in Europe. You are also making a push to grow in your personal advisory service, right? Institutional and family office wealth. What do you want to change? What are the new things that you can bring to Vanguard?
Yeah, I would say, Matt, to your point, it's really been about two things. Certainly some of it is around what all are the new ways to serve clients or the new opportunities to deliver value to clients. And I hope and expect some of my external kind of experiences would help with that. But I will also say the majority of my interviews with the board, even coming into this role, were all about culture and the cultural fit. Because I think the first and most important thing is not just having a leader, but having a leadership team that really kind of advances the mission and the purpose that Bogle set out 49 years ago. And so it's those two things. But to answer your question around the future, look, some of it I'm learning and understanding. I think there's more to do outside the United States in terms of the opportunities in Europe. But I'm going to be spending some time there later this month and getting a firsthand view around that. I also think when you look at issues like retirement income, for boomers particularly who have accumulated really well with us over the years, but now need income and drawdown solutions, that's a really big deal. And even first-time investors and getting people who might be investing in their late 20s or early 30s and would really be drawn to the type of proposition that we have, but maybe haven't heard of us in the way that I might have heard of Vanguard in my late 20s, early 30s. And so those are a few of the things, but a lot of it is really just listening and understanding where the opportunities are and what fits with Vanguard's culture and what fits with our ethos as well.
Wondering if this part of the market fits. If you think about the explosion you've seen in private assets, you've seen Vanguard really be a behemoth when it comes to the big liquid indexed market. How much do you feel that you need to encompass some of that change that's been happening in the market? Just very recently, your alma mater made 2 major acquisitions when it came to the private markets. Do you feel that you need to have a bigger foothold as well?
Well, it's interesting. Vanguard, from its origins, also had active management, kind of going back to even the founding of the firm. And if you look at our clients' assets today, about 20% of them are in actively managed funds. Sometimes it's through active managed sub-advisors, like we typically do in equities. Sometimes it's in our active fixed income capability that Sarah Devereaux and our CIO does kind of within Vanguard. And the thing that unifies both of these, because Vanguard sometimes is thought of as an index versus active, I don't think that's the truth. What we're really about is low-cost investing. And low-cost investing applies in index and it applies in active. And I would like it over time to also apply in private assets, to your point. We'd struck a partnership a couple of years ago in private equity, really just to test this theory about can you bring lower cost investing to private assets? And it seems like there's some demand there. But if you really look across the universe and what we're about bringing lower cost, kind of simpler forms of investing to individual investors. We've shown we're doing that in index. We've shown we're doing that in active. And I think to your point, there's a broader universe in which we can apply that, where we can add value to our clients and where we can partner with firms that do some of the things that we don't.
It's interesting listening to this conversation because you've made clear that culture is what you're really concerned with. That's at the top of the priority list, that you really want to stick to Jack Bogle's mission. But it seems like when you look to the future, some of those things could come into tension, private equity being one of them, crypto being one of them. You think about how to stay relevant and grow an audience among younger investors. I mean, do you see a tension there? How do you thread that needle of sticking to your knitting, but also remaining relevant and creating relevance among a younger subset?
We have a term that I've come to learn in Vanguard of does it load? Which is really, and what it really means is does the investment offering that we may come up with, does it help on the efficient frontier? Does it really fit in the context of a broader portfolio? Now, we may be conservative from time to time in our view on that, but we're very deliberate, we're very methodical, and we're always looking at, first and foremost, does it fit in a client's portfolio? And is there distinctive and unique capabilities that we as Vanguard can provide, either on our own or through partnerships like we've done with sub-advisors for many, many decades? And so we're always looking at that through a portfolio lens. And I think for some things like private markets, which have become a much more important part of an overall portfolio, And you can see it in institutional clients kind of all over the world. But the key to whether it loads is, can we offer something that's very specific to Vanguard, which means lower cost, which means it fits with a portfolio, which means simplicity. And I think there's a great deal of innovation that we can do kind of in that regard as well. But it's got to be true to who we are. It's got to be true to our own principles, whether as investors or whether in terms of clients.
Exciting new era over at Vanguard. Of course, that is Vanguard CEO Salim Ramji. He is staying with us. But let's first get you a quick check on the markets with Bloomberg's Abigail Doolittle.
And today, of course, we have indexes of all stripes and sizes selling off, including large cap and small cap. That Russell 2000 down the most since 2022. But take a look at this specific Bloomberg index of the Magnificent Seven over the last 3 days in a correction at the lows. At the lows today, down more than 9%. That was the worst day going back to March 16th of 2020. So that's the degree of the selling power or the pressure. And of course, for many months, people have been asking how far, how fast can these big tech names go? Well, now we know the answer. The music is stopping. One question, though, is will it stay stopped as people are scrambling for chairs? So we, of course, have Apple down 4.6%, Microsoft down a little bit less, Tesla down about 5%, and then NVIDIA. This is really where the real pain is. This stock, ahead of its correction and then bear market, had been up on the year, 180% on the year on the AI craze, now really crashing down. This was a chart that we showed last week, and what we see here is this ugly broadening formation. There was a chance it was going to go up to the upside, but you can see clearly we are breaking out of this formation. The sellers just absolutely dominating. The buyers have disappeared. We've been talking about this gap down in the 90s. That has now filled. However, it looks like there's more selling pressure ahead. We will probably go down to this 200-day moving average around 80. There's even reason to think we will go below that. The RSI hasn't even gotten to oversold. That is how far, how fast this stock had gone, Matt. Equal opposite reaction, Newton's third law. Well, we're certainly seeing it in big tech, and NVIDIA is a massive piece of what's happening today here in the U.S. with this stock sell-off.
Absolutely. Abigail, thanks very much. Abigail Doolittle there looking at NVIDIA, and I should note she has called those moves now for at least a week. Let's get a check on what's going on the indexes. Down 3% or more on the S&P and the NASDAQ. The Russell 2000 down 4.33%. In terms of the 2-year, right now we have it down, still the yield on the 2-year down, but only, well, less than 1 basis point. So pretty much recovered his entire move on the day. The VIX at 42, it had been 65, so a real recovery there, although still obviously at an elevated level, and the yen down at 143. Just a few weeks ago, it had a 160 handle. Coming up, more with Vanguard CEO Salim Ramji. We'll look at fee reductions and improving customer service as a priority next. This is Bloomberg.
Whether it's like the conference.
All right, we're back now with Vanguard CEO Salim Ramji. We've really been chatting through the commercial break, but let's talk about customer service, because you think about one of the issues that seems to keep coming up for Vanguard. It seems to be quality around customer service. You've said that that's a priority, but I'm hoping that you can get a little bit more specific about how you plan on improving it, whether that's increased investments, are you hiring more? What's the actual plan to improve it?
So I've been spending a lot of time, Katie, in the past 4 weeks, just really listening to clients and understanding from them firsthand what they love about Vanguard and what they want us to improve about Vanguard.
Yeah.
And this is not just kind of large wealth managers or large kind of workplace kind of clients, but also individual investors and joining our advisors on the phones. And really understanding kind of each of that. So the first piece is make sure I've got all the facts and really hearing firsthand from our clients about both aspects of them. And there's a huge amount of loyalty, affection for Vanguard. And so that in moments where we let a client down, clients take it very personally, so do I, and so do all of us. I think the encouraging thing, as I've come to learn, is that starting about 3 years ago, we'd made some very significant investments in modernizing our technology to make things more cloud-based, to make things much, much more resilient. And I benefit from a lot of those infrastructure investments that have been made over the past few years.
So are you planning on doubling down on that, so to speak?
We're going to continue to invest behind giving our clients the experience they expect and deserve from us. And so I'm understanding exactly what the investments that we've made. Many of these are behind the scenes and things which are important enablers. I sat all of last week with our personal investors team to understand all the changes that are now underway and all the ones that are planned for the future. But that's an important priority for me to understand, for us to continue to invest in part because of the great deal of loyalty and trust that our clients have, and in part because of the expectations they have for us to continue to deliver to them not just low-cost investing, but low-cost investing with high quality and a high level of experience. And we think because of technology and because of some of the investments that we have been making, we can do all of those things.
Salim, you know, of course you've been a pioneer in low-cost investing, but there is a sense here that perhaps some of the industry fee pressures have gone far enough. Bloomberg Intelligence has suggested that maybe you could hold the line here and use some of that extra fee income to reinvest in customer service. Is that an option for you?
We are always looking at ways in terms of being able to invest back in client experience. And as I said, some of the technology investments were made and well predate me in technology, and we will continue to invest behind things that get our client experience to where our clients expect them. And one of the beauties, I think the real genius of the original model that Bogle had set up is that our clients are our owners. And so we are singularly focused on one constituency, which is our clients. And so after important reinvestments that we make back in our technology and in our client experience, we can also continue to invest behind the mission of low-cost investing.
Right.
And as we talked about earlier, Sonali, I sort of view this across the spectrum. I view it in indexation, I view it in active management. If we can extend that to areas like private assets, often through partnerships, great. Because I do think, even though the mission has kind of been going on for 49 years,
right.
There still is a lot of opportunity to bring lower cost, more accessible investments to millions and millions of people. And that's what our business model allows us to do and actually necessitates that we do.
So we have less than a minute left with you, and it sounds like, again, there's a lot on the priority list. But I'm wondering, when you look out into the future, could you ever see taking Vanguard public?
No.
No.
No, I would never do it. I don't even think it's possible.
Jack
and
Bogle would roll over in his grave.
Well, as I said, the original model, and I think one of the geniuses of the model, and the reason why the culture and the ethos are so real at Vanguard, is because of this model that we are singularly focused on our clients because our clients are our owners. We have no doubt in our minds who we work for, and I think it's a great, beautiful, reinforcing kind of mechanism that still has a huge way to go. In terms of helping first-time investors, helping people who want to retire understand how they draw down. And so, like, that I think is one of the great kind of original geniuses.
Wouldn't an IPO be counter to what Bogle started the firm
Hearts
for?
are
I mean, it would ruin
breaking all over
everything.
the place.
It would. It would. And it would both do those things, and I think it's genius what was originally set out. And so, like, yeah, why would you change that? Particularly because there's a space for a firm that clients trust and that knows that we're always on their side and we're always kind of reinvesting, whether it's in fee reductions, technology improvements on their behalf. And that's
Salim,
what
let me
we're
ask you, as an outsider coming in, do you feel any pressure to do that? Has anyone said you should IPO?
Zero.
No.
Zero. All right, that's a good place to leave it. Salim, it is great to see you. Really appreciate you making the time. 4 weeks into the job, that of course is Salim Ramji. He is the CEO of Vanguard. This is Bloomberg.
This is Bloomberg Open Interest. We're going to take a check on stocks here because, of course, you have the S&P 500 still down on the day, about 2.7% or so, but off of session lows. It was an ugly morning, but the NASDAQ 100 now only down about 2.9%. Still feels bad, but down less than it was before. Those small caps, mid caps, Russell 2000 still feeling some pain to the tune of more than 4%, guys.
All right, let's take a look at the cross asset as well, because this, as we've been really driving home, is a cross asset story. You take a look at the board right now, the 2-year Treasury yield calming down a little bit. We're down about 2 basis points on that 2-year yield. Of course, we got ISM services at the top of this hour, coming in a little bit better than expected, I would say, maybe breathing a sigh of relief when it comes to that 2-year yield. Maybe fewer people are going to be calling for an emergency Fed rate cut right now, but we'll continue to follow that story. Take a look at the VIX, also calming down a little bit. But if you had told us on Friday we would be trading even at 39, let alone 60, I think a lot of people would be shocked. And then finally, just to bring it all home, you take a look at dollar yen right now. We're at a 142 handle. That pair currently weaker by about 2.7%, Matt.
Yeah, actually, got a note from a viewer earlier saying maybe some of this is the unwinding of the Trump trade that we were talking about in the first couple of weeks on this program. And it does look like that if you look at the small caps. Also take a look at some of the crypto stocks that had risen with such strength, with Bitcoin, obviously, on optimism. I think in part that, Donald Trump would start a giant reserve of Bitcoin. Coinbase is down 5.25% right now. Apple down after Warren Buffett sold off tens of billions of dollars worth of the stock. It actually ended last week higher than it started last week, but is off now 5%. Nvidia off now 6.8%. It had been off 14% at one point, so a lot better than it had been, but still at that $100 range that Abigail Doolittle has been talking about for a while. You want to give us the trading diary, Sonali?
Sure, I can do that. You need to be watching this week because, of course, we have more earnings ahead. Earnings from Caterpillar, Uber, and Airbnb. Uber has been watching to watch lately. We'll keep more of an eye on it tomorrow. Wednesday, Disney, Novo Nordisk, and SoftBank. Disney in the morning, of course, will be fascinating. And on Thursday, Eli Lilly and Alibaba rounds out the week with earnings on Friday. Of course, more about the Chinese consumer than the United States one, but those moves in China interesting nonetheless.
And join us in the C-suite this week. We're talking to Lucid, Robinhood, and Edgewell, just to name a few. This is Bloomberg.